All right. Hello, everybody, and welcome to another Pepperstone Learn It Live webinar. Today, we're going to be talking about advanced scalping indicators for MetaTrader5, and we're going to be taking a look at the real charts and also some theory. So we'll be going through everything. Can everybody hear me? Just to make sure. Hello, Jonas. How are you? So everyone could just type in the comment section they can hear me. That'd be great. Perfect. Looks like we're good. Okay, so what we're going to be covering today, we're going to be looking at live chart analysis of the US dollar index and the major Forex pairs. We're going to be looking at key setups to trade on smaller time frames, how to identify stop loss and take profit levels, and of course, live Q&A if we have time, which we probably won't, but still ask your questions and we'll answer them as best we can. So like anything at the moment, looking out for special and big types of news is incredibly important. So we have Fed Chair Powell is talking quite a lot, and as anyone that's been following the markets would know, the Federal Reserve has changed a lot of the way that we have to interpret fundamental events, and more importantly, the biggest liquidity and the biggest volatility spikes are happening around these discussions. So make sure you have an economic calendar, especially if you are a scalper, because I would hate for anyone to be caught on the wrong side of what Fed Powell says. He is really moving the markets, and you need to be aware of that. So make sure you always have an economic calendar that you can get access to. So which trading pairs are best to start with? We always get asked this question whenever it comes to scalping. Now we're going to assume that you have some knowledge of what you're looking at, but obviously US dollar majors, major crosses, gold, all of these kind of pairs are excellent scalping techniques. And you want to be trading them at certain times of the day. So like we always mention, if you're a scalper, get in half an hour before the market session opens. So if we're talking about, let's say the Asian session, we're talking about 10 a.m. start in Australia here, maybe get in at 9:30 and start to do your analysis based on the previous day close and look at things like the yen, the pound Aussie, the odd US dollar, the New Zealand pairs, anything that's trading in that Asian session as well as gold, because they're the ones that as the markets in Asia will open, you'll see increased liquidity and you'll see an increased amount of money flow. I mean, Ty, how many times did we used to see during the London breakout, half an hour before, you would see massive moves and great setups happen, didn't you?
Yeah, absolutely. Especially when you were around that key support and resistance zones. And quite often, that's where you've really got to be careful about the potential false breakouts as well, because they love that sort of stuff. So it's a great time to trade, but you really want to be on your toes and making sure you're really watching and understanding your key zones at those areas, because the market does move very quickly and it loves to trick you.
Yes, everything here will be available online for you to have a look at. It won't be direct slides, but the slides will be recorded. So let's have a look at the pound US dollar just here quickly here. And I just wanted to bring this up because it happened today. So I've got a whole bunch of indicators and other things that are on this chart, but I'm actually just going to remove them all just for a minute. So I'm just going to go back to, let's call it a standard template. The reason I want to do that is because I think Tyron and I have the firm belief that if you're going to scalp, you still want to be scalping around key areas. So I wanted to just quickly draw this resistance up and then bring it down onto the smaller time frames and talk about this level here that happened today. So if everyone can see my arrows that I'm putting on the screen, Tyrone, can you see these arrows?
Yes.
Yep, perfect. So we're just going to draw to the top here. So this 127.45. The reason I want to say that is we're on a 15-minute chart here, but we could be on a 5-minute chart. In fact, we'll go down to a 5-minute chart now. And look at how the market has interacted with this zone. Lots of nice little closes and rejections off this market. And in fact, I want to highlight this particular candle here, this little rejection candle. So a lot of people would be thinking, oh, I'm going to scalp that candle down. That looks like a shooting star in a 5-minute. Let's sell. And were you correct for a few pips? Yes, you certainly will. But what you're not going to be correct for is necessarily getting a huge amount of movement out of that trade and being in the direction of trend. So the reason I bring this up is because if we actually look at the overall trend of the pound US dollar on a larger time frame, you're going to find that it's pretty much unequivocally up. If we look at this 4-hour, it would be hard pressed for you to say that this market is not bullish at this time. So why would we as scalpers fight that bullish trend? Most people do. Don't get me wrong. I know most people are going to fight it. We did it at the beginning. Everyone does. and you think, I'm going to get it back and I'm going to get the biggest point. But what you're better off doing is when you see key breakout zones, you're better off taking the trend and buying into that. So you see this little close over here, and that particular close signals that this candle here signals that we could buy on this 5-minute chart. And then it gets better than that, because what we could do is we could take the distance of that move. So we could take the distance of this previous little swing, extrapolate that out, and that can become our profit level. So we could basically say, okay, we're going to buy it here. We're going to place our stop loss maybe behind the last big swing over here or behind here. And then we're going to take it for this distance. And by recognizing this key resistance kind of before a market open, or in terms of like, this is the scalp pretty much coming into the London kind of time frame, we've been able to get in, get out, be all over it, and then now we've seen it break to the low. So we know this level is key. This support line continues to be key. So now it's broken through here and it's broken through that little 200. Do we think there's going to be further selling? There's definitely a good chance it's going to be further selling. And again, we can use the market to kind of tell us what potentially might happen. So something like this movement might happen. And where does that put us? Back into the previous support. So we're basically just recognizing key areas or key zones. And if you were shorting it, it's never going to be as successful as if you're going long, because you're following the big trend when it comes to the long side. And I think that's what I wanted to really reiterate. I mean, Ty, how important is it as a scalper to try to follow those trends and try to be with the market movement?
Definitely. And the good thing is, look, when you are scalping, and it's probably one of the more important things that you'll learn, is that it doesn't really matter what chart you're on. I mean, this is obviously a 5-minute chart, but you're going to see the exact same setup on a 1 hour, on a 15-minute, on a 30-minute, even a 4 hour. They're going to look the same. The key is to actually know what you're looking for and trade it the exact same way. You don't have to trade. You don't have to change up your strategy because you're on a 5-minute chart. You're going to trade this exactly the same as you would on a 4-hour chart. And that's the important part. Yes, you've got to be more reactive. When you are scalping, of course, you have to be, a little bit more in tune, because if you're not in front of the charts when it's happening, you're more than likely going to miss it, right? I mean, if it was a daily chart, obviously you've got basically a day to watch the daily candle close at a particular key support or resistance zone. But on a 5-minute chart, I mean, if you were here, 25 minutes ago, this wouldn't have even broken. So, and that's I think that's the point. You have to be very, very switched on when you are scalping. But that said, you're doing the exact same thing on a 5-minute chart. You can see a little channel there. You can see the support and resistance, the role reversal that we're looking for to go up. And just as importantly, like Thomas has pointed out, the distance that we're expecting this to go is the same distance as the high, which is going straight into the new support zone. So really, really important.
Yeah, so that, just before we go back into the slides, that's the thing that we want to do. If we follow the trend on the bigger timeframes, usually we'll have more success, but we also want to use the market to tell us where to go. In terms of what moving averages these are, they're 20 and 50 EMA and the 200 SMA, just so you're aware. So as we mentioned then, the top-down approach, we talk about it all the time because I believe it is an advanced, and so is Tyrone, it is more of an advanced technique from just going on the 15-minute and 5-minute time frame and just thinking, okay, well, I'm seeing this one go short, let's go short and let's go long. You want to be aware with as much information as possible. It's like having a good business plan. If you have a great business plan, then you have a chance of having a great business. If you have a poor business plan, then you have a chance of not doing as well and you won't be well thinking out something. So by using a top-down approach and coming from maybe a daily down to a 4-hour, down to a 1 hour, down to a 15-minute, down to a 5-minute, and understanding what the trends are doing and what's happening on the higher end timeframes from a support resistance price action side, we can then bring our indicators in and be trading with that general trend. So we want to be able to do that as much as possible. How do we recognize trends? Well, we've talked about these heaps. We always talk about peaks and troughs as part of our course as well. We make a big deal about being able to recognize trend without using just indicators, because remember, indicators are lagging. While they may not lie about what's happened, they are lagging indicators based on the previous chart action. If you can read chart action before it all happens in the indicators, do you think you'd have an edge? Yes or no? You most likely will. So that's why realistically being able to use price action as your base for any trading scalping session or day trading or swing trading or whatever you're looking at is so key. So understanding peaks and troughs, very, very important. what types of strategies? So we talked about this a few weeks ago. We said that we had channel breakout strategies, moving average trends with role reversal and possibly even Bollinger Bands. And then, of course, we have channeling markets, and that's where the stochastics and the MACDs come in and the RSIs come in. So many people love MACD. They love MACD divergence. And, of course, they love stochastic and RSI. I mean, Ty, which is your favorite indicator out of all of these?
It's a good question, and we get asked it a lot. I have a particular liking for MACD because it gives us information in a sideways market as well as the trending market, and also it can be very, very useful even if you're scalping or if you're looking for a bit of a change up for a swing trade. I do love MACD, but yeah, that said, moving averages, especially the 20, is definitely one of my favorites. But they've all got their place, and look, there are only 5 indicators that Thomas and myself actually use, that we use religiously and actually teach in our courses, because they're the ones that we know work well together, and they all give you very different opinions of what the market is actually happening. So a moving average is obviously just a moving average of those periods. The Bollinger Bands are using the volatility. And stochastic is giving us the price action momentum as well. So they're getting their information from very different sources. So if they all agree with what is happening with price, it's a really important concept, because you're getting very different. You're getting a volatility indicator. You're getting the moving average indicator. You're also getting a momentum type indicator from stochastic, and a price action indicator, which is what RSI and stochastic kind of overlap to do. So it's really, really important in that regard that that information is not crossing over. So if they're conflicting, they're conflicting for a reason. Whereas there are a lot of indicators out there that you can use. There are thousands of indicators that you can use, but what we find is a lot of them conflict with each other, or they actually complement each other in a negative way. And by that I mean they're really giving you the same information, and that's really something to be aware of, because if you're using even 5 indicators that are all really telling you the same thing, and they're getting their information, if they're all momentum indicators, for instance, just to give you a bit of an idea, if you're using 5 different momentum indicators with different names and they all agree with the direction that you're going to find and say, oh wow, I've got 5 indicators in my direction, this has got to be a good trade. No, not at all, because all you're doing is really compounding what you already know, that momentum's in your favor. But do you have volatility? Do you have price momentum? That sort of thing needs to kick in. So it's really, really important to make sure that you use indicators that are complementing what you're doing, but also complement each other in a positive way.
So that idea of complementing indicators is so important. We do not want to use every indicator under the sun. We want to use specific ones that are telling us slightly different information so that we can bring together a story. There's no worse feeling than actually using the same indicators effectively, because each one of them is telling you the exact same thing, but you think it's 3 separate signals. So as an advanced trader, you need to be aware of that. It's a massive rookie mistake that unfortunately a lot of people make. So here we have the Japanese yen. I actually want to just quickly show on the 4 hour. So there was a key level of role reversal that happened this week, where basically if we zoom this out on the 4 hour, a lot of people are seeing this, and we were ones included, where previous resistance could become support. The thing is, though, it came down with an incredible force. Look at how fast this came down. So obviously there's a lot of scalping opportunities potentially on the way down here. But even after it gets through this zone, once it closes below this and does what it did here, there could be further scalping opportunities for us in that direction. I mean, we've already got a very defined kind of trade going on here. So when we go over to the 15-minute chart, what you're going to notice is that there's a few times that the Bollinger top end range gets reached, and then at the same point that reaches, we also have the potential for things like maybe an overbought stochastic, or we've got the potential for RSI to be high. So I think on the second one here, which is probably the better one, we have an overbought stochastic. We've got a pretty high RSI. If we put in here a range between kind of like the 70 and maybe the 50 or 60 area, what is that? It's about 63. There you go. So we've got pretty high RSI, and we like to trade a little bit higher in terms of where it is. And you can see that it's outside that Bollinger. So what the market will generally do is when a Bollinger is breached, the market will generally try to revert back to the median or the mean area of this Bollinger. And what we saw here was in the direction of trend, you could pretty much trade this where you're taking the breach all the way to the bottom of the Bollinger. So that may be all you're looking for. As a scalper, we have to be quite fast. We're on a 15-minute time frame. We don't want to be in there too long, but at the same time, this is still, a couple of hours during a session. So what if this happened where we saw the Bollinger getting breached, we had a fairly strong downtrend on the larger time frames, and we had that overbought stochastic into the direction that we wanted to? Well, maybe then we could go down and have a look and see if there was another reason for us to be in the trade, even on the smaller time frames. Well, there definitely could be. We've got our RSI well above 70 here. We've got our stochastic well above. We could sell it. And as I said, our profit could be when the market goes back to the other side of the Bollinger in the direction of trend. We just take profit there. As soon as it hits that Bollinger, we're watching it, we're taking, and then it's done. And that's actually a pretty relevant and pretty decent strategy, as long as, again, you're following the trend. If you saw something like the market, as you can see here at the same time, is coming back to the 20 moving average, and we have 20 moving average on all the time. Look how the 20 moving average interacts with price over time over here. Then you can use that 20. You could say on the 15 minute, was it hitting the outside of the Bollinger? So you can go from the 1 hour where it's here and it's hitting the 20, and then you can go and have a look at the 15 minute there, see if it's breaching the outside of the Bollinger at the same point, buy it if the stochastic's underneath, and then literally just take it at the other side of the Bollinger. That's all you're doing each time. You're kind of in and out on that trend inside of a larger trend.
That's right.
So that would be...
It's very important. And what I'm going to do, actually, I'm going to address a question that we get asked a lot about role reversal. Mm-hmm. If we can just go back to the 4 hour on the US dollar yen.
Yeah, let's do it.
What a lot of people do, and look, if you follow us, you know that we always preach that role reversal zones are a fantastic way to re-enter the market. Absolutely 100% correct. Now, this particular one obviously was a really good role reversal zone. It was obviously resistance plenty of times over, and then it came down very, very sharply. So your automatic trade, a lot of people, and I know this caught a lot of people out, was they're automatically going to buy at this level. Now, the problem with this, and I actually did the Tuesday video on it yesterday because it was really, really relevant. What happened here was this was an inverse head and shoulders playing out. Now, what you've got to be really aware of in a role reversal area is that it hasn't actually gone to the move that you would have expected it to do. And this is exactly what this one did. So yes, it did break through that role reversal zone and break up and shoot higher, but it did go a considerable amount of distance. So basically the pattern basically played out, and it came down at the rate of knots. So what you're doing here, this is not a time where you just want to be taking the first entry of that role reversal and assuming it's going to go back. What you need to do is take it back to a smaller time frame and make sure that you get that change of trend on a smaller time frame. Now we'll leave that horizontal line there, and we'll go to a 15-minute chart, and I'll tell you exactly what I'm talking about. So when it came down, you can see here that it tested it for a little while, then it made a new high, and then it came back down. So you can see there, what it didn't do on a 15-minute chart is actually change a trend. What you needed to happen here was basically the lightning bolt effect that we always talk about. It needed to do exactly that. If it did that, then that role reversal is actually relevant. Very, very big tick for that one. But it didn't do that. And if you're doing the right thing and actually waiting for that to happen, you would never have got caught in this trade, because it was really screaming that this role reversal zone was going to get a lot of people caught out if it didn't do the right thing, because it came down at an extraordinary pace. But just as importantly, it actually fulfilled its pattern all the way up. So you've got to be really, really careful on those ones and wait. Now, if it only broke through a little bit and only went, say, a quarter of that distance and came back and touched it,
I'll show this.
Very different scenario. Yep. Go on.
So let's say we got to this level here, and then we found resistance and it came back down. And this is relevant to scalpers as well. It's relevant to everybody because you're looking for the key levels. When it comes back down to this level, because it hasn't even reached 50% or 60% of what your expectation is, this is a pickup area. Whereas what Ty was saying is it's already reached what we expect. So yes, this could still hold. Yes, it's a key level, but we need to see that change of trend first, because it basically came down like a locomotive. I mean, there was probably another fundamental reason why this is happening, but yeah.
It was screaming that it was going to. Unfortunately, people did get caught up in it because they're used to trading a role reversal. But just be very, very wary that a role reversal is only a good like trade when it hasn't really gone the distance that you would have expected it, and if it's not coming down like an absolute rocket ship.
Absolutely. Well, thanks for that, Ty, and that's a great point. So yeah, with that US dollar yen, we learned kind of a few things there. We learned about the role reversal. We learned obviously that if we're looking for the key levels on any time frame, if things come down at a sheer massive pace, wait for that change of trend. If you're a scalper and you're trading the 15-minute time frame, wait for the 5-minute change of trend so that you can see it pick up. Yes, you're going to lose a couple of pips and you're not going to get the absolute best price, but you're following the market momentum and you will have more success by doing that. And it seems like it goes against a lot of, counter kind of intuitive or something like that, but it's really the right thing. So when we recognize channeling markets, we mentioned before that we can recognize channeling markets. Well, one thing that a lot of people would like to do is that when you recognize this, you might want to buy at the low here and sell at the peak here. Now we can do that by, of course, using stochastic. And when it's overbought, we look to sell. And when it's oversold, we look to buy at these levels. We can also use things like certain candlestick patterns, like maybe engulfing candlesticks or hammers or any of those types of things. So if we see these types of candles at the bottom, then we might want to be able to take the position long. But the other thing we can bring into is we can also bring in MACD. So we can discuss that if we see lows here, and let's say the MACD hump was like this here, but the MACD hump was only like this here, that's what's called divergence. And there's different types of divergence, and we won't go into every single one of them today, and we have covered stuff, so check out, of course, the Pepperstone YouTube channel to find our videos on divergence. But if you see, let's say, divergence here, oversold stochastic here, and potentially a hammer here, you have found 3 key reasons to be in a trade. And the reason I want to mention that is because when you find 3 key reasons or more to be in a trade, you are really collecting a business plan and collecting a story from the market that means you've got lots of traders in your direction. And it's very, very important to do that. So with a channel, that's what you want to be doing. Now, of course, the other option with channels is that you buy and sell them when they break through. So we talk about this all the time, where if it closes above, that could happen before a session open. Now, we mentioned come in half an hour early. There's a lot of fake outs that happen in sessions, but as long as you wait for the confirmation closes, you could potentially get in, take the distance of this move, being this distance here, extrapolate that distance out and be in and out of a scalp very, very quickly. And the great thing about trading, let's say the London session, which is great for London traders, European traders, and especially Asian traders, because you get home maybe from work, is that you can potentially see the pre-market open of London, and that you can see all of this action, and that there's so much trading and volatility during that time. But more importantly, the back end of the Asian session is well known to consolidate. So because it's consolidating, guess what it could be creating? It could be creating a channeling market. So it could be creating a market where effectively this is happening, and it gives you all of those opportunities coming into London. That's just excellent. Double bottom patterns, we talk about those all the time. They are on the charts. And of course, we've got the role reversal, which we were mentioning before. We're going to assume that you know these things and that you know what role reversal is. But if you see key resistance, doesn't matter what time frame it is, if you ever see this and you're coming in, let's say at this point here in the market, and then you're seeing at this point here an oversold stochastic, you're seeing a Fibonacci retracement, you're seeing maybe something like a rising histogram on the MACD or something like that, you're finding enough reasons. And remember, if we had a bullish hammer here as well, because of the nature of the previous resistance, this will act as very strong support, and it will either give you a great trade, a great scalp, or it will give you the opportunity to at least get out of it if it was to break below. Because you already know where your stop loss needs to be. Your stop loss just has to be below last swing, especially if you wait for it to break through here. So very, very excellent there.
It is a really good point. I'm getting quite a few questions about looking at specific pairs. We're not doing that in this one because this is more a teaching webinar, but if you're interested in analyzing the live markets with us, we're going to be doing that in about 30 minutes time at our webinar. So any live market analysis, you can pop the questions in the next webinar if you like. I'll pop the registration link in the chat window, so people can jump in on that one if they like. It's free and it starts in half an hour. So fire off your questions for any live market analysis in the next webinar.
This question is actually very prominent, very, very decent for what's actually here, which is the don't FOMO emoticons, Ty. So basically, Colin says, thoughts on using a tight trailing stop loss instead of taking profit using the Bollinger Bounce techniques so that I can sleep while potentially getting a larger profit? Well, I think there's two ways to look at that, Colin. What you could do is you could scalp, take 75% of the trade off, and then leave 25% of it on, and always use that and just break even your trade. Or you could find maybe a swing or something like that you like in the market where, let's say something like this is happening. So before we were doing a sell-off. So we had that top end of the Bollinger, we had the stochastic, I believe, and then we also had, some support resistance kind of roll reversal as well. So we had all these other reasons. Then we're getting into it. It hits this level here and you want to go to sleep and you're like, okay, it's hit my normal take profit. Why not take 70, 75% of the trade off, and then we can either break even the trade, or we can look at where the moving averages are and potentially move our stop just behind the moving averages, or we can even look where the Bollinger is and move our stop behind the Bollinger. I always prefer to use something that's market adaptive, or at least to those market conditions, than using a straight trailing stop loss. The problem with the trailing stop loss is this. If you have a trailing, let's say we've got the market coming down, and then you always trail it by 20 pips, okay? Then you're not being market adaptive for the move. Not all moves are the same. Not all moves have the same aggression. 20 pips might hold a few times, but then you're going to get stopped out and it goes back 22 pips. And then you start thinking, well, maybe I'll use a 23 pip stop loss. And I know this because we've all done it. Tyrone and I did it. We did it. I tried this many years ago, back in 2008. It was hilarious. Yeah.
And we tried every number there was. Yeah.
I remember scaling this. I remember thinking, okay, we've got 15 pips and now we're going 17. And then we tested 17 for 2 weeks. It went badly twice. And then we decided that was bad. And we didn't really think about market adaptive concepts. We just thought, oh, well, we'll just keep getting the pips refined. So that's the big problem with it. So by using a moving average or the Bollinger or something like that, you will find generally more success.
Yeah, actually, we've got another question here that has just come in the window, and I think it's probably one of the most relevant questions that that people really need to know. And it says, instead of using a stop loss, why not hedge it out and wait until the market gives you a signal to go back in? Okay, where do I start with this one?
I know you want to do this one.
Yeah, I will do this one. Look, in theory, it sounds logical, okay, and it does sound logical. You think, well, you just hedge it out. It can't get any worse. Your position is just going to hover there, and then when you think it's going to go right, then you'll get you'll either stop the closed off position or you'll join in the existing one. Whichever it goes, you'll do the right thing for it. It very, very rarely works. I've never seen a case where, and I've seen a lot of good traders in our time, like we've got a lot of them in our room. I've never ever seen that strategy work and that strategy not blow you up in the long run. And the reason it does is because it's very, very it's difficult straight up to actually get the hedge right. That's your number one problem. And what you do find is the minute you do place the hedge, what's going to happen is the market will end up going in your favor the way it was going to anyway. The only difference is you're not actually getting your profits that you should be, because you're obviously losing one for one. So, and then you're going to say, well, what happens when it gets to the next roll reversal zone or the next support and resistance? You're going to add any technical you want. The minute you add a hedging type strategy that does reverse a trade like that, you're going to come unstuck eventually, unfortunately. And it does sound good. And look, we've done a lot of research on it. We had an EA that actually specifically did that. We programmed it, paid a lot of money to make it do that. It just didn't work. It never did. And I don't believe it ever will. The only time that we advocate hedging out of position, Emmanuel, is actually if you're going into a big news event over a weekend and you're very concerned that it could blow out your trade, but you really don't want to take it out, then it's okay to basically hedge it out at the same price, or very close to the same price. So whether you're up 50 pips or whether you're down 50 pips, whatever it is that you're at, if you reverse it at that point, that's okay, because at the end of the day, whatever happens on the market on the weekend, whether it's a G20 summit or whatever it is that you're concerned about, no matter what the move, it's going to be matched out by the other one. But all you're doing there is actually protecting a position, okay? You're not worrying about a stop loss or anything like that. You're just making sure that if you have an adverse move against you, you're not going to lose out at all. You're going to be costing yourself as a couple of pips in spread, which is perfectly fine. So you can do that in that instance. But what I do suggest on the Monday when you do open up your trade, don't try and be a pinpointing expert on which way it's going to go. Stick to your original plan. And if your original plan doesn't look like it's going to play out anymore, so the market's moved adversely against you, don't look for luck. Close them both out. You're only going to be a couple of pips different because you hedged it out anyway. That is the only time that hedging is okay.
I'll just read this, Ty, because I think people resonate with other traders saying things. And this person says, OMG, that was me. Tell whoever this is, don't do it. You are paying double swap and they will not serve you any purpose. They obviously serve you a purpose over the weekend, as Tyron mentioned, but in general, you can get in a lot more trouble than it's worth. And that's why I have this don't FOMO, and I talk about this all the time, which is because it's so important to scalpers. You have to be like a rock. You have to be a machine when it comes to scalping. You have no emotions. Always think I have no emotions. Even sometimes I've recommended to people, they literally just get whatever their denomination money is. They put $100 in front of them. They always realize it's real, but at the same time, we're just going to trade with percentages. And I really do wish that in all platforms, you could kind of change things to just percentages and pips rather than dollars, so that then you could scale your business and scale your trading even better. So look, we mentioned obviously that you want to become an expert with scalping on certain currencies. Now, because you're scalping, because you're trading the smaller time frames, an advanced technique is becoming an expert in knowledge around that currency and the way it moves into pre-market. You're going to want to look at potentially months of data pre-market, go back over it, have a look at how the market ebbs and flows before that news. Think about the news when it comes out. Think about how important that news is. As I mentioned at the start of this, I would not be scalping around Jerome Powell's discussions unless you want to take more of a gambling approach, because he will push the markets in certain directions. If you want to get involved in the trend afterwards, there's usually going to be even more to go. But yeah, you need to be careful, and you need to always think, okay, what currencies am I going to become an expert at? Especially with scalping. Swing is different. You can actually trade a lot of range with swing trading because you can use the same concepts and they usually will work everywhere. But with scalping, you need to become kind of like one with that currency. You need to understand it, and then you need to become expert at it, and then you need to understand the times of day that you're going to trade it. Very, very important. Okay, so I just wanted to talk about, again, just that top-down approach kind of concept. And I'll do it with the euro. And I'm just going to do it with the euro because you want to have a bias in the market as an advanced technique. So here is the euro. We can all see that the euro was trapped for a period of time, and then it broke out ahead of the ECB statement last week. Now, we don't believe that as a scalper, you shouldn't be looking at fundamentals. And this is a huge mistake people do. They always link, the ECB is going to do this. I'm going to scalp the 2-minute chart because of this fundamental news. Fundamentals take time to play out in the market. Yes, there's instant reactions to the news event. News trading is a little bit different. But when you're trading based on a fundamental approach and you're scalping a 5-minute chart, ask yourself the question, is what you're doing on a 5-minute chart really packed price based on this massive concept? So if your concept is that the ECB is pushing billions of dollars into the market and you're going to trade that fundamentally on a 5-minute chart, I don't think that's the way to do it. You'd be trading a daily and a weekly and saying over time that's going to happen. You want to trade what you see. You want to trade the indicators that you're going to use. And as we mentioned tonight, stochastic's a great start. RSI is a great start. Bollinger is a great start. They are all excellent indicators for the right knowledge. So when this breaks through on the daily and it gets through that 200 moving average here, what do we think our bias is going to be on the smaller time frames? Well, it's definitely going to be long, and we're going to be very aggressively long because we know it broke out of that channel. And by doing that, then we can get involved in this. Notice how the market interacts with the 20 moving average here. Remember what we said about the Bollinger. You bring the Bollinger in You put it on the chart, you put it on the 15-minute chart, you recognize when an hour hits, you go down to the 15-minute and 5-minute, you find your confirmations, and you take it long. And all you do is take it long. Most people, and I'm getting a bit ranty about this because so many people try to counter this. I can see it. I open up the sentiment trader and I'll load it right now. And I'm going to guess that there is a huge amount of people that are shorting the euro. Look at that, 31% of people are long. And the majority of people are shorting the euro. Now, why are you fighting the trend? Has the trend changed yet? No, it hasn't. Is it at a resistance? Sure. But this entire time, 80% of people, in fact, it's gone down, 80% of people were shorting the euro. And unfortunately, they were going against the trend. I was watching it. I might as well take a picture every day.
Thomas is getting a bit antsy about this, and
no,
and
look, I get
good
really
reason.
annoyed about mean reversion.
It is. It's good. Look, it's good, and it's really important because the thing is, we've made all the mistakes that everybody else has. Okay, like don't take us wrong. We've done everything there is to do that is wrong with trading. So we don't want people to make the same mistakes. And I don't know why it is, and we did the same thing at the start. We insist on reversing markets. We want to make sure that we're going to reverse the market ourselves single-handedly with our half a contract. We're going to reverse the market and prove it wrong. It's almost it's a very, very strange occurrence. But 90% of traders who first start out want to fight the market. The easy path is always the path of least resistance. Okay, and that's why we get passionate about it, because we know full well that if you do this, you're going to be far more successful. If you do trade in the direction of the trend, then be more cautious at resistance points. Of course you are, but at the same time, this resistance just happened here. What's happened every time it touched that 20 moving average? Like you've had multiple. You could have got in every single 15-minute candle at some point on some of those trends. So there's always opportunities to get into the it looks like it's not the easier way, but it really is the easier way. Don't counter trend, especially if you're first starting out. I know it's the easier way. I don't know why people think it is, but it's not. In reality, it is absolutely not the easy way. The trend is your friend.
Yeah, and I couldn't have said it better, Ty. So remember, 1 hour, define the trend, come down to the smaller time frames, recognize the moving average is holding or a roll reversal area or whatever you want to do, and then just trade in the direction. And just use your indicators and use your approaches in scalping to get those scalpel-like entries in the direction. So hopefully that helps everybody today. But I do think it's an advanced technique, and the only reason I say it's advanced is it might seem simple, but I ran because so many people don't do it. I think it's because I answered it 3 times today. The exact same question, and they wanted to short it and they wanted to go against the trend. They just said, follow it. So, once you've done this 1,000 times, it always is the same thing. And I have no idea why human psychology is built that way. Well, I do, but you know what I mean. Like it's funny how everyone does that. So some chart patterns. Now, Tyron, we have a chart pattern cheat sheet that everyone can have if they're interested. And in it has we'll put it in the room and share it with everybody. But in it has all of the most popular, or we think the best chart patterns used for scalping, used for swing trading, used for day trading. It doesn't really matter. They'll work on all of them. Now, I'd actually recommend for most people that they stick with double bottoms, inverse head and shoulders, and ascending and descending triangles. And then maybe steer clear of the flags at the beginning. And that's because of the nature of what a flag is and how you're going to identify it. It's not a horizontal. Notice how all these have horizontal support resistance areas. They're easier for you to spot. So until you get to the advanced, intermediate, or even more extreme level, I think that flags are a little bit tough, and you need to be able to, of course, correctly identify them. You want to wait for confirmation with everything. So I still think that price action is great with indicators, but you still want to make sure the indicator switches around. It has maybe the cross that you're looking for or anything like that. Always wait for confirmation. That will save you a lot of pips in the long term. What market conditions do we look for? Well, obviously, we want to stay away from Fed Powell, and we want to stay away from non-farms and those kind of events because we consider those more of the gambling kind of events. We want to know our times and market conditions, so whether it's trending or range bound. And more importantly, when we're scalping, we want to be absolutely in there half an hour before the market opens for those particular currencies. And we'll mention them again. If you were trading the Asian session, pound odd, US dollar yen, gold, odd US dollar, New Zealand US dollar, all great pairs to be trading then. And it makes sense, of course, just trade the pairs throughout the day to do with the sessions. Again, we have some trading groups. Feel free to join the Pepperstone and FX Evolution's trading groups. And of course, join our YouTubes. We've got Pepperstone. If you search it in, you will find Pepperstone's YouTube, and FX Evolution has one as well. It's going great. So come and join us over there and meet the rest of the people in the community. Sound risk management strategies, it's a no-brainer when it comes to scalping. You want to have the best management possible. Do not be risking 5 or 10% per trade. Unfortunately, it's a recipe for disaster. Even the best trading systems can have streaks where you lose between 6 and 7 or even 10 times in a row. It's possible. Anything's possible, remember? And therefore, the damage that could do to your account if you're risking heaps could be obscene and too much. So always think about it's not a race. It's more of a slow kind of build up that you want to be. You could be the tortoise, and at the end you will beat the hare. Ty, we do have this lockdown special that I want to mention to everybody. We basically are ending this thing today. We were ending it on the weekend, but we chose to just quickly run it till this Wednesday, Pepperstone. So basically we have a $50 per month foundations course based on price action, all the indicators we're talking about. We have full access to the course straight away. You get it all immediately. You get to join our private Discord on top, which has about, 12 or 13 rooms for everyone to talk about different currencies, indices, everything. It's pretty amazing. Heaps of people, and there's hundreds of members in there. Tuesday market wrap, we do a special one for every one of the private members, and then we do a Thursday Q&A. So if you've had questions you want to ask people that do this all the time, you can just come in and do that. You can also join us, of course, at more Pepperstone webinars in the future. And all of the information is currently fxevolution.com. And there's a little kind of banner up the top, and you can click that, and we'll post it in the room now. And that offers that special, but it will be gone tomorrow. That's the end of it for now, because it was, of course, lockdown, and we're technically out of lockdown. You want to always have a business plan. What's that? Wait, what do you mean?
According to ScoMo, we are out of lockdown. So yes, so I agree.
There we go. We're out of lockdown, so it's over. So look, you want to have a business plan as much as you can for whenever you're doing the trading. It is the key. Whenever you talk to anybody that's a professional trader, they'll always say, look, I follow my plan. Not everyone has to be right. If they've been successful and been around a long time, they all say the same things. And that's because it's the kind of keys to success. It's one of the pillars. So have a great plan. As part of our system, we obviously have Prefix. That's included in that foundations course, price action, risk management, ELD system, chart patterns, indicators, and charting techniques. We want to have one, ideally, from each one of these kind of pillars. And then once we have all those reasons, we place the trade. It makes us better traders. It makes you more consistent.
Very similar to what the indicators are telling us. When you're getting pieces of information that are very, very different in what they're telling you, and they all agree, it gives you a chance a far better chance of success when you are trading in either direction. So definitely apply a trading plan, and it will make a very, very big difference to your day. So hopefully everybody enjoyed this learning webinar. We love doing these. Feel free to send any suggestions that you have for future ones to Pepperstone. Let them know what you would like us to cover, because we are in your hands. We're very happy to basically customize these webinars to the best of our ability to get the audiences really loving and enjoying what we do. So feel free to pop in your opinions to Pepperstone about what you would like us to cover. If you want to do the live market analysis webinars, you've got to come to ours. We always run them after at 9 p.m. Melbourne time. And I believe our next webinar, our next Pepperstone webinar, is in 2 weeks' time at the same time. So if you don't get a link to that one, it is in 2 weeks. So yeah, make sure you contact Pepperstone for that. You'll get a link for that one, and it'll definitely be on a different topic. But don't be afraid to send through your requests for what you'd like us to cover, because we do want to make it as interactive as possible.
I got a question here. Manuel is still talking about the hedge. He goes, can you split it 5 ways? Look, you can do a lot of things. The thing is, though, that you're asking too much of yourself. You're overcomplicating the hedging idea. Hedges are good for eliminating weekend risk, eliminating gap risk, but they're not tools for you to get in and get out. If you could scalpel and be that good all the time, you would be, one of the best. So you need to find high statistical likelihood areas. So think of it that way.
Yeah. Emmanuel, Thomas and I, we don't say this lightly, we're pretty reasonable traders, and we cannot hedge. So, take that as you will. We are pretty good at what we do, and we cannot hedge, and we don't hedge because we actually are not good enough to be able to do it. I haven't seen anyone who is. So if you can do it and you can do it successfully, all power to you. But if you're looking for us to tell you that it is going to be working for you, you're not going to get that answer from us, because we just simply cannot do it. Okay, so hopefully hopefully you take that on board, and just you can trade successfully without having to hedge. If you put stop losses in the right place, keep good risk management in play, you're going to be a successful trader doing it that way. You don't need to hedge.
Think of it this way. If you look at the hedge fund managers out there, 90-something% of them underperform the indices over the long term, over a 10-year gap period, because they're hedging larger time frame, larger concepts. That's actually a lot easier to do than the shorter concepts. The shorter concepts are so much harder to hedge. So hopefully that helps. And look, everybody, we look forward to seeing you in 2 weeks or in a few minutes. And thank you very much for coming, and we appreciate your feedback. Thanks, everyone.
Thanks a lot, guys. Thank you.
Bye.